Right. So, good morning. So, we're going to discuss Australian New Zealand Bank, or ANZ, which we call. So, I'll be discussing financial forecasting and financial leverage. So, all of in this meeting room, all of us know how to compute the pro forma income statement. So, most of us know on how to get the percentage sales. You just have to get the percentage, then times it on or multiply it on the given number that is being provided. But here with ANZ, what we do is the 2019, what you're seeing on the screen is 2019. That is where we get it from the ANZ annual report. And then on the left side, which is the 2020, that is the forecasted income statement. And as we all know, pro forma income statement, it shows the projected income and expense, which result of the operation of a firm of a specific period or year. So this is the annual income statement forecasted for 2020 and 2019. Okay, and then the next one is the balance sheet. So balance sheet, the pro forma balance sheet, it shows a projected snapshot of a company assets, liabilities, and owner's equity at a specific point in time. So all of us, even to get the pro forma balance sheet, so as mentioned on the income statement, just what we're doing in the income statement, we're going to get the percentage sales method. So on this side, 2019, we get it from the ANZ annual report, and 2020, that is a forecasted balance sheet that we got. Okay, and then moving forward, so there's all of it. It's kind of long, so if you want, I can give you like a copy of this one, if you wanted to double check it. And then the next one is so this assumption for projection. So this is the explanation how we get the forecasted pro forma income statement and income balance sheet. So first, as we follow the assumptions which has been made for making projections of financial statements, all accounts has the same growth rate as previous. Future collections depends on previous outcomes. All income statement account will have the same proportion of sales as per previous year. Based on the previous trend, future forecast has been made. All the financial statements are related. Therefore, sales are considered as the key measures for projecting different financial accounts. And lastly, it is a cost of business, which is not remaining the same as it is affected due to the inflation impact on different accounts. So if you were going to like dig it, each statement, it has a good or the projection is quite high. It's growing compared to the 2019, the one what we did on the 2020. All right, next one is the benefits for developing forecasted financial statements. So the finance is the key element for the business, and the management need to make sure that business have enough resources to meet the operation requirements. So therefore, financial forecasting of ANZ Bank becomes essential, which is the key benefits for financial forecasting includes providing better control on business cash flow, percent financial viability for investments, minimize future risk, measuring financing requirements, and acquiring financing for business. In addition to all of this, it maintains the current information routinely, and it enables the business to utilize financial statement projection for business decision making and compare changes with actual and projected financial performance. So just to have a like to make it short, the benefits of having a forecasted financial is to have at least to know what will be the outcome, their numbers by next year. Right, and then next one is the break-even analysis. So break-even analysis is commonly used to analyze the relationship between sales volume and profitability. So from the costs and benefit analysis of ANZ Bank, it has been identified that company can attain the break-even point at 600 number of services. So by measuring the break-even point, the cost per service has been identified along with the price per unit. So this measurement has been on the following formula. So the formula of break-even point is fixed costs over gross margin, which is a percentage. And then this is the graph of our break-even analysis. So as mentioned, break-even is like a project or a company will not have any profits or losses. So it needs to have like it should be crossing with each other. And basically that's the end of my report.
Thank you, Novie. Okay,
All right.
so just let me invite someone to ask
Mm-hmm.
a question. Okay, so let's see. Jamila, oh no, Jamila is your group. Okay, I cannot
Yeah.
ask Jamila to ask a question. Okay, so let's try Jackie.
Hello, Jackie.
Jackie, you need to
Yeah.
unmute yourself.
Buena, Jackie.
Can you hear me?
Yes.
Yeah. I don't know if you mentioned, but how much was or was which was the number of the growth rate? How much increased the sales for the
Which
due to the
which slide?
The pro forma.
the pro forma? I mean that
This
we
is
Oh,
use
also
that,
my
the
question.
sales
this,
method.
okay.
So how was the percentage or which is the
So
number?
yeah, what is the
All right.
increase rate of the sales?
Yeah, the increased rate of the sales,
All right.
the growth
So
rate.
all right, good question. So what we did is only a forecasted. Actually, I didn't give. So we let me check just to make sure because all of the information is here, which is the how we get the projection. But the percentage is at 5%.
Okay.
Yeah, but for example, if you tell me saying you are using 2019 minus 2018 divided by 2019, give you like say, the increase rate, right, of the sales, and then like you are saying you are using just consider it should be consistent the sales increase rate. So you are just using this like sales increasing rate for the 2020 as the way. Then so what is like how you actually get the increasing rate? What numbers are you going to use?
Okay.
If you say it's 5%, then how you get is 5%?
We got the 5% from the if when we look on the sales.
Mm-hmm.
So let me just check here. I'll open the whole uh PowerPoint, okay?
Mm-hmm.
The-
Hello, Nancy. Can I explain that also?
Yes, yes.
Jackie, we got the forecasted balance sheet and got the forecasted income statement. We calculated first. We calculated the difference between the sales for the values, and we calculated the profit margin, and then we got the percentage of the value to be calculated, and then we got the forecasted statement. We prepared looking at the differences from the 2018, 2019, and 2017. Those are the three values years that we looked at, and then we got the values. Uh, do you have any other question? Do you want me to
No,
explain more?
no, thank you.
Thank you, Jackie, for your question. Okay, so Novie, right? So okay, you need to also show the process, right? So my suggestion will be you can discuss about like how you get the, for example, the increase rate of sales and how you are using it as the percent of sales method here. Okay.
All right, noted, Nancy.
Yeah. So noted that, and then it's like my another question. Yes. Do you have the pro forma cash flow statement? Why I think you only have the income statement and the balance sheet. Do you really have the cash flow statement as well?
Let me just check here.
Nancy, we have it in the, I just forgot to paste it in the report. I have prepared it.
Okay.
It's there.
It's there, right?
Yeah,
All
yeah,
right.
it's there. So we have prepared the cash flow budget of forecasted cash budget. Yeah.
Okay. All right. And then like Novi, when you go move on to the break-even analysis, so you give me the formula, but what are the like process? What numbers are you going to insert?
I
What
forgot
is
to indicate we do have the table actually. But I forgot to post it on my
on the
presentation.
slides?
Yeah, on the slide.
Oh, all right.
We have the
So
table and we
If you
calculated
want, I
from the
can.
table and then we got the graph, but it's
Uh,
in the report, Nancy.
it is
I think
actually
we
on the
forgot.
okay, yeah. As long as it's in the project, so that's okay, all right?
yeah,
Yeah,
it
because
is.
because right now you can't make any changes on your, let's say, the presentation slides because it's already been recording, okay?
Yeah,
So when you send me the slides, you have to send me as this original one, okay?
yeah.
Unfortunately,
I'll just insert it
yeah.
on the original PowerPoint.
No, you cannot add anything to these slides because all these slides has
Okay.
been recorded, all right? So which means it's like the slides you send me later in the Viva email should be the same as the one you are presenting here right now.
Okay. All right.
You can't make any change on the slides, all right?
All right. No problem.
Okay, so I'm going to stop